Welcome back to the Rock and Turner Investment Podcast. We're excited to have you join us for another episode filled with valuable insights and expert analysis to help shape all of your investment decisions.
Before we begin, please note the following legal disclaimer. The views and opinions shared in this podcast are intended for entertainment purposes only. Any references to regions, countries, sectors, stocks, securities, or other assets are for discussion purposes and should not be considered as recommendations to buy, sell, or pursue any specific investment strategy. This content does not constitute accounting, legal, tax, or investment advice and should not be relied upon as such. The material may include forward-looking statements, forecasts, or projections, which are inherently uncertain and not guarantees of future results. There is no assurance that any predictions or projections will materialize. All data referenced in this podcast has been sourced by us and is provided without warranties of any kind. The data may contain errors and should be independently verified before use. Neither we nor the data providers accept liability for any reliance placed on the information presented. Always conduct your own research, seek professional advice, and take responsibility for your investment decisions.
This is James Emanuel on the Rock and Turner podcast. Welcome back. This is now the third podcast on the topic of programmatic and serial acquirers. Previously, we've looked at companies in Scandinavia, which is a hotbed of activity for acquisition as a business. But today we're moving around the globe to India, and a very interesting programmatic acquirer. But before we dig into the company itself, let's explore the country. Why India? Top investor Jeffrey Gundlach recently made a bold claim. He thinks India is the most compelling investment opportunity of our time. Let's hear what he had to say.
You should invest in India, because India has a similar profile today to where China was 35 years ago, when they had tremendous population, labor force, visibility of labor force growth, tremendous problems, a gummed up legal system, corruption all over the place. But those are things that can be fixed. And you see, but China went from 1/12 of the US GDP to 70-80% of US GDP, and they certainly produce more goods than the United States, so in a certain sense, they're bigger. Well, India has the same demographic outlook as China did then, and India has a benefit for supply chain being moved around, for manufacturing can come there. They're very technology. They have a long history of being, a significant society. So I don't know how long it's going to take, but that's one that you buy and you just do yourself a favor and don't open the statement. Because if you do, when there's trouble, you're going to sell it.
So let's dig a little bit deeper. Why India? It has a huge population, a young, fast-growing workforce, a rapidly growing middle class, shifting winds of global supply chains are driving it forward, and a reform agenda that echoes the early days of China's rise in the 1980s. In Gundlach's eyes, today's India looks a lot like China did 35 years ago. Chaotic, corrupt, bogged down in red tape, and yet it's bursting with untapped potential. But Gundlach is a realist. He isn't pretending this will be a smooth ride. In fact, he warns the opposite. His tongue-in-cheek advice, don't open the statement, is a wink at the kind of turbulence and nerve-testing headlines that can often come with investing in emerging markets. But if you believe in India's long-term fundamentals, you have to give them time to unfold. That means ignoring any short-term noise and holding steady for the long term. Against a backdrop of global economic uncertainties, India has positioned itself as a resilient and fast-growing major economy. India's G20 presidency was a transformative moment where the nation shifted from being a participant in global affairs to a key architect of international cooperation. India's presidency came at a critical juncture, with the world grappling with a convergence of crises, including post-pandemic recovery, climate change, food and fuel shortages, and escalating geopolitical tensions. While the G20 is not a trade negotiation platform, India's presidency provided a significant stage to project itself as an attractive destination for investment and a rising manufacturing hub. Initiatives like Made in India and the push for resilient global supply chains, highlighting India's ambition to play a larger role in global business. During Prime Minister Modi's decade in office, a remarkable transformation has taken place in India, with changes evident in social, economic and regulatory areas. There have been improvements to insolvency and bankruptcy laws, significant reduction in corporate tax rates, banking and real estate reforms that have provided transparency to both of those sectors, and the start of privatisation initiatives, which are paving the way for future growth. Tremendous progress is evident in India's physical infrastructure, such as roads, highways, railways, ports and airports, with better transportation logistics aiding in the growth of businesses. And all of this is feeding through to the underlying economy, and there's real dynamism to India's startup ecosystem. It's become a hotbed of innovation and entrepreneurship. This is so much more than just aspiration and rhetoric. So let's look at some of the numbers. Looking at financial year 2014 to financial year 2024, so a period of a decade, GDP has increased from $1.9 trillion to $3.5 trillion. More particularly, GDP per capita has increased from $1,500 to $2,500. In the same period, 4 times as many people have bank accounts and internet subscriptions. There's also been a huge drive to increase access to mobile phones, and this helps explain why digital payment volumes are up by a factor of 85. And all of this activity is feeding through into the economy. Foreign direct investments have doubled from 36 billion to 71 billion. Foreign exchange rate reserves have increased from 300 billion to over 650 billion. The number of stocks with a $1 billion market cap have increased from 166 to 522. And the number of unicorns has increased from 8 to 118. In fact, on the global league table, India is third by number of unicorns. Growth has been astounding on every measure. India's economy has maintained an annual growth rate of between 6 and 7% over the past decade, demonstrating resilience even in the face of pandemic-related challenges, and this looks like it will continue. Just to put that in context, over the next 2 years, 2025 and 2026, India is expected to grow in the mid 6% range. Meanwhile, China is anticipated to grow around 4%, and the US is expected to grow around 1.7%. In fact, the average global growth rate is expected to be around 2.8%, so India is expected to grow at twice the rate of the rest of the world. This probably explains why India's contribution to global GDP has risen from 6% to 8.2%. Domestic consumption is vibrant and the country has become a top foreign direct investment destination. Its healthy foreign exchange reserves have made its currency amongst the least volatile, and a disciplined approach to maintaining its inflation targets has provided flexibility to weather geopolitical pressures such as wars and oil price fluctuations. On the issue of oil, the only point worth raising is that India seems to have exploited the sanctions on Russian oil, buying cheap oil to supplement its own economy. For obvious reasons, this has upset the US, and President Trump has imposed a 50% tariff on India in order to try and influence some kind of change. For the sake of this analysis, I'm assuming this is a short-term headwind and that the matter will be resolved within months. So more generally, as India becomes more prosperous, its vast population, which is similar in size to China, will act as a huge tailwind because it represents the size of the domestic consumer base. India's aspirational class is growing fast. This is why investors need to sit up and take notice. The rapid growth of India's domestic investor base has created a self-sustaining market dynamic, often insulating the market from global trends, but also leading to elevated valuations. Foreign portfolio ownership in Indian equities has declined to its lowest in over a decade, in part because domestic flows have made it harder for overseas investors to find value. But this creates wonderful opportunities for those who know where to look. India's financial landscape is evolving rapidly, and at the heart of this transformation is the rise of private credit. Once a niche segment, it's now becoming a mainstream financing option. This is largely because traditional banks, constrained by tighter regulations, are finding it harder to lend as freely as before. As a result, more businesses are turning to private credit for its flexibility and speed, especially when time is of the essence. The numbers tell a compelling story. In just the first half of 2023, over $4 billion in private credit funding was dispersed. That momentum carried into the first half of 2024, with deal volumes approaching $6 billion, and for the corresponding period in 2025, this surged to a record $9 billion, representing a 53% increase year on year, a clear sign that this segment is not only growing, but doing so at pace. In addition, private equity has been gaining ground, adding further depth to India's capital markets. In 2023, private equity investments reached around $62 billion, propelled by strong investor confidence and booming sectors like technology, healthcare, and infrastructure. The trend has continued through 2024, and big-ticket investments in startups, green energy, and consumer-focused businesses have played a major role in sustaining the activity. What's particularly interesting is how private equity and private credit are now working together. Private equity firms are increasingly teaming up with credit providers to deliver blended financing solutions that combine the benefits of both debt and equity. This collaborative approach is helping meet the increasingly sophisticated needs of Indian businesses. And together, these developments are reshaping the contours of corporate finance in India. By offering viable alternatives outside of the traditional banking system, private credit and private equity are fostering a more dynamic, responsive and resilient investment environment. And this is all relevant to the investment thesis that follows, so bear with me on this. Navigating India's investment landscape can be challenging for foreign investors. They have withholding taxes and other fiscal rules which can erode returns. There are restrictions on the free movement of capital in and out of India. Foreign investors can't freely convert large amounts of rupees into foreign currency at will, which complicates both the repatriation of profits and the exit process from Indian investments. Currency controls and the lack of full convertibility require foreign investors to navigate complex regulatory procedures to move capital in and out of India, and this can lead to delays, increased transaction costs, and uncertainty about the timing and value of repatriated funds. There are the obvious language and cultural barriers, which make due diligence and interacting with senior management particularly challenging. And all of this, combined with the risk of sudden governmental policy changes, can undermine investor confidence, which is why gaining exposure to India via a holding company may be the better option. So this brings us to the programmatic acquirer that I'm looking to focus on in today's analysis, Fairfax India. And it begins to look very attractive as an investment opportunity. It went public in early 2015 and has since enjoyed a 10-year investment journey in India, providing it with invaluable experience navigating the complexity of this market. Prior to that, its parent company, the enormously successful Fairfax Financial, had been active in India for 2 decades, so the in-house expertise in this jurisdiction is extensive. For those not familiar with this group, under Prem Watsa's visionary leadership, Fairfax Financial has transformed from a small, struggling insurance company into a global powerhouse. It's headquartered in Canada, but operates in over 100 countries. And since the inception in 1985 of Fairfax Financial, it's achieved a remarkable compound annual growth rate of around 19% in book value per share, placing it among the top 1% of listed companies over nearly 4 decades. Watsa is a disciplined, value-oriented investor, and his focus on long-term shareholder value has earned him the reputation as the Canadian Warren Buffett. For long-term buy and hold investors, this is the right type of business with the right type of culture. The launch of Fairfax India was driven by Prem Watsa's conviction in India's long-term economic potential and the transformative impact of a business-friendly government under Prime Minister Modi. Watsa saw a unique opportunity to create a permanent capital vehicle focused exclusively on India, allowing Fairfax to make significant long-term investments in Indian businesses with experienced and ethical management teams. He believed that India's favourable demographics, cost competitiveness and vast domestic market would position it as a leading global manufacturing and service hub, and that Fairfax India could benefit from these trends by investing in essential sectors, infrastructure and high-quality companies. The structure of Fairfax India, distinct from Fairfax's other global operations, was designed to provide patient long-term capital and to leverage Fairfax's 3 decades of experience in the Indian market. Fairfax Financial currently owns approximately 43% of Fairfax India, making it the largest single shareholder. The public float comprises the remainder, with retail investors holding around 36% and institutional investors holding the rest. In fact, Ontario Municipal Employees Retirement System holds around 15% alone. Fairfax India has itself gone through a transition since its inception. Watsa's son, Ben, took over from him as chairman, while Gopal Sundrajan took over from Chandran Ratnaswamy as the CEO. And both Prem Watsa and Ratnaswamy continue to be on the board of directors. While some people may be concerned about the changing of the guard, rest assured, Fairfax is one of those groups that handles succession properly. Prem Watsa himself has explained, "Our presidents and senior executives at Fairfax average close to 20 years of service. We're big believers in the benefits that come from this continuity. Rather than shuttling in new leaders every 4 or 5 years, our companies are able to continually build on success without undergoing the strategic U-turns that management turnover often brings." Here again you can probably see another parallel with Warren Buffett. Prem Watsa owns 1.2 million Fairfax Financial shares and 320,000 Fairfax India shares directly, while other officers and directors own shares in both companies. This is a business where management has real skin in the game, and the team is exceptionally talented with a wonderful track record. Now we get to the really important part of the thesis, because there's a valuation disconnect that you really need to understand. Since its inception 10 years ago, through a variety of crises including the pandemic, Fairfax India, on paper, looks to have generated an annualised return of 10.2% on its existing portfolio. I know what you're thinking, satisfactory but not outstanding. But here's the thing that you really need to understand. Nearly 70% of Fairfax India's investments are not publicly traded and are carried at valuations that are very, very conservative. That means that the annualised return is actually far higher than the 10.2% that appears on paper. Allow me to break it down. The company operates under IFRS investment entity accounting rules, meaning public investments are marked to market while private investments are valued using fair value methodologies outlined in quarterly reports. The mark-to-market return on existing public listed investments is about 18.5% CAGR, significantly outperforming the Indian Sensex index. But here's the thing, despite the private holdings growing as strongly as the public listed companies, the company has conservatively assessed their fair value at a level that implies that they're growing at only 7.3% CAGR. In combination, this gives the 10.2% that I mentioned earlier. But why should a company grow more slowly just because it's private? The answer is that it doesn't. The carrying value of these businesses is well below their intrinsic worth. So if we assume that the private companies have indeed grown as strongly as the public businesses in the portfolio, then that average increases significantly, and the real number is at least mid-double digits, if not higher. This explains why many, including myself, believe that Fairfax India is significantly undervalued by the market. You'd be right to be sceptical, but this isn't wild speculation. Fairfax India has achieved an annualised return of 25.5% on partially monetised investments and 18.3% on fully monetised investments. In aggregate, this amounts to an annualised return of 19.4% for all monetised investments. Better still, of all its monetised investments, it has never lost money. So now I'm probably starting to pique your interest. For you to better understand this company, we really need to break it down on a sum of parts basis and to analyse all of the individual components. So that's what we'll do. But before we dive into this analysis, a word of warning is warranted. This is not an easy company to analyse because, unlike a typical operating company that earns revenue from selling goods or services, Fairfax India does not have a core business that generates predictable recurring sales. Its income is a function of its investment portfolio's performance, which is by nature cyclical and subject to market-wide economic conditions and specific company events. As a holding company, its accounts are subject to accounting standards that require it to capture both realised and unrealised gains, something Warren Buffett has raised as an issue at Berkshire Hathaway, so not a unique issue being faced by Fairfax India. In respect of its listed investments, its revenues are directly tied to the performance of the stock market. It also receives revenue in the form of ad hoc dividends that are paid at the discretion of the companies in which it's invested. Then there's interest income, which can vary based on the debt instruments held and prevailing interest rates. And complicating matters further, its investments are all in India generating income in rupees, but it reports its financials in US dollars, exposing it to foreign exchange fluctuations. If you look at its numbers, you'll notice that all this causes its top-line revenue to be incredibly volatile, with swings in either direction from one year to the next. The company's philosophy, mirroring that of its parent company, Fairfax Financial, is to prioritise long-term capital appreciation and book value growth over short-term quarterly earnings. This approach is rooted in the belief that for a holding company, a rising book value per share is the most reliable indicator of a successful investment strategy. So the focus needs to be on the balance sheet. By compounding its book value per share over the long term, it's creating sustainable value for its shareholders. The company provides detailed breakdowns of its investment portfolio's performance in very detailed and well-articulated financial reports, so there's no issue with transparency. It's generally an excellent capital allocator and repurchases shares when they're trading at significant discounts to book value, but this is also captured in the book value per share metric. But there is an issue here that you may have spotted. As noted earlier, 70% of Fairfax India's investments are not publicly traded and are carried at valuations well below their intrinsic value. So the book value per share cannot be calculated from its financial statements. It needs to be analysed on a sum of parts basis. Fairfax India addresses the understatement of its book value per share by providing supplementary information beyond the standard financial statements, in which it consistently highlights the intrinsic value of its underlying private investments and discusses the significant unrealised gains in their portfolio. Their monetized investments validate their conservative approach, and they demonstrate a significant profit on the books upon the realization of those assets. All of that to say that shareholders must look past short-term accounting fluctuations and focus on the fundamental value being created. Most investors either don't have the capacity or the ability to do this kind of work, and so this explains why Fairfax India is so poorly understood and so heavily underpriced in the market. The stock is certainly not as widely followed as other large companies. This lack of institutional interest and analyst coverage means fewer eyes are on the company, and its story is not being told as broadly as it could be. The hidden value in this stock will be unlocked in time through a number of catalysts. The primary driver will be monetization of private holdings, when it realizes the gain and the cash flows onto its balance sheet. Its value will then no longer be a matter of debate. The most anticipated example will be the IPO of Bangalore International Airport Limited, BL. A successful public listing of BL would not only validate the company's valuation of this asset, but could also lead to a substantial one-time increase in book value and cash, forcing the market to re-rate the entire company, but more on BL shortly. As the company continues to acquire, grow and sell assets at a substantial profit, the market's confidence in its valuation process and management's capital allocation skills will increase, attracting more investor and analyst attention, and the discount should naturally shrink. This is the long-term engine for value creation. Fairfax India has a history of being a disciplined and aggressive buyer of its own shares when they trade at a significant discount to book value. This is a very shareholder-friendly way of returning capital and a strong signal from management that they believe the stock is undervalued. So to help you gain a better understanding of the value of this business, let's break down the individual components of the portfolio and discuss realistic valuations for each. Most of Fairfax India's investments are in outstanding companies with a history of strong financial performance, led by founders and management who are not only excellent leaders, but also adhere to the highest ethical standards. Its investments have all been sourced and reviewed by Fairbridge, a wholly owned subsidiary advisor in India of Fairfax Financial. The portfolio is fairly concentrated, testament to the confidence of the company in stock picking. Of its 14 investments, 5 of them, which is 28% of the portfolio, are in financial services. Another 5, 17% of the portfolio, are in manufacturing. 3 more, 7% of the portfolio, are in transportation, logistics and storage services. And the single largest position is in airport infrastructure, as I mentioned earlier, a monopoly that comprises 48% of the portfolio. Fairfax India is a permanent capital vehicle which is able to focus on the long term, and this distinguishes it from most investors, giving it a real edge. It always stands ready to make acquisitions, and privatizations in India may open the way for some really interesting opportunities. By way of example, in January 2022, the Tata Group, another major Indian company, took over Air India from the Indian government, a successful privatization which brings hopes for India's debt-ridden, loss-making and grossly inefficient flag carrier, which was run into the ground by successive governments. And while that deal sits outside of the Fairfax India portfolio, it may pave the way for other such privatizations, and Fairfax India stands ready to pounce if the right opportunity presents itself. Remember that nearly 70% of Fairfax India's investments are in privately held companies, so the ability for you and I to buy shares in Fairfax India is an attractive proposition, as it offers us exposure to opportunities which most investors are unable to access. When it takes a stake in a private company, Fairfax India is large enough to be able to take a controlling stake if it wants to, another huge advantage. It rarely acquires another company outright. Instead, it takes a majority stake and then gradually scales that into that position as time goes by. Since the jewel in the crown in the Fairfax India treasure chest, and its largest position by far, which was recently 48% of the portfolio but I believe may now have risen to 51% of the portfolio, is Bangalore International Airport, BL. So it's important to shine a spotlight on that particular investment and to explain what makes it so special. Catering to rapidly increasing demand for air travel, India has expanded from having 50 operational airports in 2000 to about 157 today. A further 50 airports are being commissioned. This doesn't mean more competition because each airport typically serves one region in this vast country. It means more people will have easy access to air travel, which translates to increasing passenger traffic at other airports, since a flight from a new airport must land somewhere else. Today there are about 800 aircraft in operation in India, yet leading Indian airlines have placed orders for approximately 1,800 new aircraft from both Boeing and Airbus to be delivered over the next decade, so that provides a sense of the growth trajectory. India is the third largest aviation market in the world, with about 376 million passenger flights recorded in fiscal year 2024 alone. More particularly, Bial serves as the third largest airport in India and the fastest growing globally. Terminal 2 is very special. It's first of its kind. It's called the Terminal in a Garden, and it's an extension of the Bengaluru city's green aesthetic. Imagine arriving at an airport and having to walk through landscaped tropical gardens. It has a total of 620 endemic plants, 3,500 and more plant species, 150 palm species, 7,500 planted trees, 100 different varieties of lilies, 96 lotus species, 180 rare, endangered and threatened species, and 10 ecological habitats, which make up a lush green landscape. This really is an airport like no other. It was voted second as the world's best new airport terminal at the prestigious Skytrax World Airport Awards 2024, having been recognised at the 2023 Prix Versailles, organised by UNESCO as one of the world's most beautiful airports. Beyond beauty, it's also sustainable. Its solar panels and daylight optimization results in 25% overall energy savings. Rainwater harvesting and 6 major rainwater-fed ponds with 413 million litres of water cater to the airport's requirements. The integrated solid waste management plant will convert biodegradable waste to fuel and manure, leading the airport towards its goal of sending zero waste to landfill. It's designed to provide the highest level of passenger experience while also making it an unforgettable destination for passengers. To ensure that the passenger experience is simplified, seamless and effortless, it's implemented features such as Your Face is Your Boarding Pass technology. All of this has resulted in it receiving multiple accolades, including Best Regional Airport in India and South Asia, the Cleanest Airport in India and South Asia, the Airport of the Year at the Wings India Awards, the Best Airport Cargo Business at the India Cargo Awards 2024. I think you get the idea, the list goes on. In fact, it's strategically positioned as the main airport in southern India, benefiting from Bangalore's status as India's software capital and pharmaceutical hub. The airport ships significant perishable goods and has expansion plans including additional terminal phases. Passenger traffic grew by almost 9.5% to 41 million passengers in 2024, a record, and international traffic was 5.5 million passengers, up over 20% year on year. Cargo volume reached another record high at 496,000 metric tons. Phase 1 of Terminal 2 was completed in 2022, increasing capacity from 20 million passengers to 50 million. Phase 2 is now underway, which will take the capacity up to 80 million passengers by 2029. A third terminal will then be added, taking the capacity beyond 90 million by 2033. This is a total investment of $2.5 billion to be funded part organically and then supplemented by debt. It has 3 main sources of revenue. Aero revenue includes aircraft landing services and parking and that type of thing. There's non-aero revenue, which includes food, beverages, duty-free. And then there's the monetization of 460 acres of land known as Airport City. So this really is so much more than just an airport. Airport City is a large-scale, mixed-use urban development being created adjacent to the airport. This ambitious project is designed to be a self-contained, smart city featuring business parks, educational and healthcare districts, research and development hubs, data centres, luxury retail, a hospital complex, high-grade warehouses, and a wide range of entertainment and hospitality facilities. It was delayed by 2 years due to the COVID pandemic, but is now firmly back on track. The core of Airport City, with the flagship development being a 2 million square foot business park spread over nearly 18 acres, specifically targeting global capability centres, is aimed at boosting collaboration and innovation. It's also planned to attract academic institutions and world-class medical facilities with R&D hubs supporting technology and innovation-driven businesses. In fact, Bial has been working with AWS, Amazon Web Services, to deliver the Joint Innovation Centre that will drive the development and adoption of digital solutions in aviation. As part of the launch of the Joint Initiative Centre, Bial will also deploy Startup Valley, a startup accelerator program that will offer an open innovation opportunity for startups to build and accelerate digital solutions. Rahul Sharma, president of Amazon Internet Services, AWS India and South Asia, explains as follows. With Startup Valley, our combined vision is to enable startups to transition successfully and faster in their experimentation, development and scaling phases, helping them to commercialize their solutions and accelerate the adoption of innovative digital solutions in the country. So once again, this is more than just an airport. This is the Indian Silicon Valley coming into being. Airport City will also offer a concert arena, a convention and exhibition centre, 5,200 hotel rooms, and so much more. It will also be enhanced by the upcoming Airport West metro station, which will connect Airport City directly to Bengaluru's city centre. The arrival of metro rail connectivity to the airport is expected sometime in 2026, so this third revenue stream has a huge catalyst very soon to take place. In short, Airport City is designed to position Bengaluru as a global hub for business technology and sustainable urban development. Local government policy aims for Airport City to create 350,000 jobs and contribute $50 billion to the economy, indicating the project's anticipated large-scale economic footprint. Airport City is being developed in multiple phases over a span of 15 to 20 years, meaning the full vision could be realised by the late 2030s to early 2040s, depending on the pace of development. The first phase, which is expected to start generating revenue almost immediately upon completion, is set to open later in 2025, with new assets and sections becoming operational approximately every 2 years after that. This project will become a significant and steady source of income over time, with the potential for substantial returns as the area matures and more tenants and visitors are attracted to the site. And the best part of the story is that Fairfax India recently increased its stake from 64% to 74% ownership by acquiring an additional 10% equity interest in Bangalore International Airport, BIAL, from Siemens Project Ventures for an aggregate purchase price of $255 million. So today, Fairfax India is the majority owner of BIAL, with minority shareholders being the Airports Authority of India holding 13% and Karnataka State Industrial and Infrastructure Development Corporation holding another 13%. While no specific long-term revenue figures are disclosed, the sheer scale of the project, over 45 million square feet, suggests a significant and diversified revenue base from leasing, hospitality, entertainment and ancillary services. Here's the interesting part. So the investment in BIAL was initiated in March 2017 and has grown since then as Fairfax India has scaled up the investment. But the total investment that is made stands at $1.2 billion. So a carrying value of $1.9 billion would represent a good return. But the true intrinsic value is far, far higher than $1.9 billion. To give you an idea, aero revenue in 2024 increased by 39% over the previous year to just shy of $220 million, while non-aero revenue and other operating income in 2024 increased by 54% over the previous year to its highest ever of nearly $225 million. With these kind of growth rates, the capacity of the airport will continue to expand through to 2033, at which time its capacity is anticipated to exceed 90 million passengers, and it ought to be generating somewhere in the region of $1.3 billion in non-aero revenue alone. Add to that the aero revenue and all the income from Airport City as each phase completes, and you start to build a picture of the kind of cash-generating machine that this will become. Now consider that in financial year 2024, total revenue increased 46% to $441 million. That was fairly evenly distributed across aero and non-aero sources, which implies that total revenue 8 years from now may well be in the $5 billion ballpark, which includes Airport City revenue. Now consider that Fairfax India is carrying this asset for $1.9 billion on its balance sheet. Do you think that's a fair valuation, or do you think it's worth significantly more? Let's look at this a different way. In financial year 2024, net profit increased 18% to $51 million, generating a 14% return on equity. At the carrying value of $1.9 billion, that equates to around 10 times normalised free cash flow, excluding cash flows from Airport City. It just looks way too low a valuation for an unregulated business with a near impenetrable moat, monopolistic characteristics and huge growth ahead. On a discounted future cash flow basis, this asset is way undervalued on the balance sheet of Fairfax India. Here's another very interesting perspective. In 2019, Fairfax India created a subsidiary named Anchorage Infrastructure Investment Holdings. In 2021, it transferred 43.6% interest in BL to Anchorage and subsequently sold an 11.5% interest in Anchorage to OMERS, the Ontario Canada Worker Public Pension Fund. Why is this interesting? Well, it implies that BL had a post-money valuation of $2.6 billion 4 years ago, and it would have grown significantly over the subsequent 4 years. This 2021 valuation implies that Fairfax India's 74% stake would have been worth about $1.9 billion back then, so its carrying value today is arguably 4 years out of date. If you require more evidence, Fairfax India considered a 2023 IPO for the airport operator, with discussions around a target valuation of $3.7 billion, double its current carrying value. It decided against the IPO, which implies that Fairfax India believed this valuation to be too low, and the airport has only become more valuable since then. The decision not to IPO back then was good news for investors because this is a premier asset with so much value still to be unlocked. Rather than raising equity capital to fund the expansion of the airport, BL is actively using debt markets for funding and hasn't moved forward with equity listing or indicated imminent plans for an IPO. And since debt is the cheaper form of financing and the true value of Airport City will only become clear over time, this is great news for investors, no dilution and the retention of a wonderful asset. As an aside, Fairfax India is in the process of obtaining regulatory approvals, which would enable it to IPO Anchorage Infrastructure Investment Holdings at some point in the future. Anchorage now holds a major stake in BL after Fairfax India transferred additional shares, consolidating its role as the principal holding company for airport and infrastructure investments in India. So it would seem as though the sale of part of Fairfax India's BL holding will be sold at some point in the coming years, and this will reveal the true value of the asset and act as a huge catalyst for re-rating. That should give you a very good idea of Bangalore International Airport, the jewel in the crown of the Fairfax India portfolio. But what else does it have in its investment portfolio? It explains that it likes to take majority stakes in great businesses, and it favours those businesses with long-term management, preferably founders who retain a minority stake and stay engaged in the business. In return, it offers long-term permanent capital, creating stability, providing fuel for growth, and it becomes a reliable partner. It prides itself on having a decentralized management-friendly approach, which enables it to attract partners that are like-minded and share its long-term approach to value creation. So let's break down the rest of the portfolio by industry sector. Our first area of focus will be banking and finance. For generations, Indians have preferred physical assets, especially gold, over banks. Even today, gold and real estate make up about 60% of household savings. It's hard to imagine, but much of this gold is stored at home, not in vaults or banks. That said, things are changing. Over the past 25 years, bank deposits and credit in India have grown at 14% and 16% CAGRs respectively. Yet despite this growth, the country remains significantly underbanked. The opportunity here is vast. As of 2021, only 13% of Indian adults over the age of 25 had borrowed from a formal financial institution. Mortgage penetration is just 11% of GDP, far behind China's 20% and the 52% in the US. Another interesting statistic is that of every 1,000 people in India, only 62 will hold a credit card. That compares to about 740 in China and over 5,000 in the US, because of course in the US people have more than one credit card each. So the runway ahead in banking and financial services is enormous, and Fairfax India is looking to ride that wave. It has a number of investments in this sector, so let's explore. First is CSB Bank, where Fairfax India owns 40% of the business. One of India's oldest private sector banks, CSB is in the middle of a transformation. Under CEO Pralay Mondal, who took the reins in 2022, CSB is shifting into a full-service, digitally capable institution. Backed by Fairfax India's investment and recapitalisation, the bank now has a capital adequacy ratio north of 21%, plenty of headroom to expand, invest and manage risk. It operates 811 branches and 777 ATMs across India, up meaningfully from the year before, with a strong presence in South India, particularly Kerala, Tamil Nadu, Karnataka and Maharashtra. CSB is also modernising its digital infrastructure with new mobile and online platforms in the works. The bank's financial performance has been strong. In 2024, revenue increased 17% to 272 million and net profit was 66 million. Loan advances rose 26%, deposits increased 22%, and its net interest margin came in at an industry-leading 4.7%, and net non-performing assets of just 0.6%, which speaks to the quality of its investments. The credit-to-deposit ratio also improved from 83% to 86%. But beyond its core business, CSB owns a portfolio of real estate, some of which was acquired via enforcement of security. So, with a solid balance sheet, strong leadership and a growing digital presence, CSB looks well positioned for the long run. The next two investments that Fairfax India has in the finance and banking sector are two related businesses, IIFL Finance, in which it owns just over 15% stake, and IIFL Capital, in which it owns just over 27% stake. So India's non-banking financial companies, NBFCs as they're known, have become essential to financial inclusion, offering credit to millions of lower income, higher risk borrowers who are often overlooked by traditional banks. So IIFL Finance is one of the leaders in this space. Led by founder and CEO Nirmal Jain, IIFL Finance has built out a nationwide network of over 4,850 branches and employs more than 38,000 people. It's heavily invested in digital infrastructure and now manages around $8.3 billion in assets, a 15% CAGR growth over the past 5 years. Its offerings range from gold loans and education loans to affordable housing finance and microcredit. It generates net interest margin at about 8.7%. And for higher income and institutional clients, there's IIFL Capital, the sister company. With over 100 branches in India and offices in Singapore, London and New York, IIFL Capital provides everything from wealth management and investment banking to broking and corporate advisory. It had assets under management of 28.6 billion as of the end of 2024. IIFL Capital has been on a tear. In 2024 alone, revenue surged 40% and net income jumped 83%, driven by booming retail and institutional broking and a red-hot IPO market. So Fairfax Financial first invested in the company in 2009 and then substantially scaled up its stake through Fairfax India in 2015. And Fairfax India currently holds 27% of this company, and Fairfax as a group owns just over 30%, nearly 31%. So over the past 2 years, IIFL Capital share price has soared over 400%, yet it still trades at just 13 times estimated earnings, an appealing multiple for a business growing this fast. The last investment that Fairfax India has in the finance and banking space is a company called 5paisa Capital. It's a new age digital first financial services platform offering low cost DIY investing and trading tools to India's growing base of retail investors. The app has been downloaded over 21 million times with a 4.3 star rating on the Google Play Store, a testament to its popularity. This company has ridden the post-COVID boom in retail investing. From 2020 until 2024, the number of active industry clients ballooned from 10.8 million to over 50 million. And 5paisa now commands nearly 10% market share. That said, the explosive growth of retail and derivative trading has caught the attention of regulators. So SEBI, the regulator, has introduced new rules that are likely to moderate the pace of growth going forward. Still, 5paisa remains one of the standout platforms in a market that is only beginning to formalise. So you can see that Fairfax India has diversified across the finance and banking industry with investments across every part of the sector. Now let's take a look at transportation, logistics and storage services. Fairfax India has an ownership stake of over 48% in Seven Islands Shipping. This is a company founded in 2002 by Captain Thomas Wilfred Pinto. It operates a growing fleet of tanker vessels sailing both along India's coast and internationally. When Fairfax India first invested in 2019, Seven Islands Shipping had 14 ships. Today it owns 26, 22 oil product tankers, 2 crude tankers and 2 LPG carriers, with plans to add 2 more in the near future. Seven Islands Shipping is India's second largest private tanker operator and the market leader in coastal time charters, holding 24% of the total market and 32% of Indian owned capacity. Its efficiency is best in class with average idle time under 12 days per vessel over the past 3 years. To support global expansion, Seven Islands Shipping established a wholly owned subsidiary in Dubai's Jebel Ali Free Zone for international vessel ownership and chartering. And Fairfax India acquired a 48.5% stake in Seven Islands Shipping for about $83 million in 2019. As of 2024, it's valued at $146 million, having already returned $30 million in special dividends. The valuation still looks conservative, just 4.6 times earnings and 3.8 times free cash flow, even allowing for industry cyclicality. The next company in the portfolio is National Commodities Management Services. This was one of Fairfax India's earliest investments, dating all the way back to 2015. At the intersection of agriculture and logistics, this company plays a crucial role in India's food value chain, connecting farmers, markets, storage and trade. The company operates 771 warehouses across 165 locations in 16 states, with 2.3 million metric tons of storage capacity. It also runs 16 regional offices, 6 testing labs, over 750 market touchpoints, and 2,380 weather stations. Its aggregate loan book totals 265 million rupees. Following a period of underperformance, Sanjay Gupta was appointed CEO in 2022. He revamped the senior team, and the business has since returned to a growth path. To support the turnaround, Fairfax India converted $14 million in debentures into equity in 2023 and added $24 million via unsecured non-convertible debentures due in 2028. Fairfax India now owns 91% of this business. With Indian agriculture still a core part of the economy, this business is well placed to benefit from long-term growth in the sector. The last portfolio company in this sector is Saurashtra Freight. It owns and operates container freight stations, which act as logistic hubs between ports and inland transport, essentially providing off-site customs clearance and cargo storage for decongesting ports. Fairfax India invested $30 million for a 51% stake in 2017. Today, the investment is valued at around $55 million and has generated $15 million in cumulative dividends, nearly half the original investment. The valuation remains modest at around 11 times earnings and free cash flow. Now on to the final sector in which Fairfax India has invested, manufacturing. Manufacturing is enjoying a strong tailwind in India thanks to the government's flagship Make in India initiative, focused on 27 sectors. Over the past decade, reforms have targeted economies of scale, higher labour productivity, lower logistics costs, a favourable tax regime, and production-linked incentives. The strategy appears to be working. India's manufactured goods exports have risen from $76 billion in 2020 to nearly $110 billion by 2024, now making up a quarter of total exports. Fairfax India is well positioned to benefit from this trend with a number of strategic investments. The first of which is Sanmar Chemicals Group, in which it owns 43% stake. This is a 6-decade-old Indian conglomerate which operates across chemicals, engineering and shipping. Then there's Fairchem Organics, in which Fairfax India owns a 55% stake. This business operates in the niche oleochemicals segment, converting waste from edible oils into high-value chemicals used in soaps, detergents, personal care products, paints, and even vitamin E and health foods. Customers include global majors like Archer Daniels Midlands, Arkema, and Asian Paints. Fairfax's stake in this company is particularly interesting. So it originally invested $37.5 million for a 67% stake. But in 2021, it sold 14% of its holding for $45.6 million. So it more than recouped its initial investment. It subsequently spent another $4.5 million, upping its residual 53% stake to 55%. But its net investment is a negative $2.6 million. So it owns 55% of the company and it's paid a negative $2.6 million for it. This highlights the skill and expertise in capital management of its senior team. The next manufacturing company is Maxop Engineering Company, which supplies precision aluminium die-cast components for the automotive and industrial sectors, serving OEMs and Tier 1 customers globally. Based in New Delhi, it runs 8 plants across Mansar and Jaipur. Fairfax India acquired a 67% stake from the founder, Shailesh Arora, for just over $51 million. The company grew revenues by 28% and net income by 36% in 2024, with gross margins over 50% and EBITDA margins in the mid-20s. With new customer wins and expanded capacity, growth momentum looks very strong. Yet its current earnings multiple is implied at a mere 10.4 times. The penultimate company we're looking at is Janix Engineering, in which Fairfax India owns 70%. Janix manufactures non-ferrous aluminium electrical components, supplying Tier 1 and OEMs in North America and Europe. And demand is driven by growth in data centers, electric vehicles, switchgear and transmission infrastructure. Fairfax acquired its 70% stake for $32 million back in 2022, and that stake is now valued at closer to $82 million, and that only implies less than 12 times earnings multiple. In the last year, revenues rose 30%, net earnings jumped 48%, and return on equity hit 30%. So this business continues to be led by its passionate founding brothers and shows a lot of future potential. Last but by no means least is Global Aluminium, in which Fairfax India owns 65%. This is India's third largest aluminium extrusion company and was founded by a second generation entrepreneur, Anil Agrawal. Serving over 25,000 customers, it generates 90% of revenue from repeat business. Yet its top 20 clients account for less than half its revenue, so it's very well diversified with no concentration risk. The Indian aluminium extrusion market, estimated at $1.8 billion in 2023, is projected to grow to $2.5 billion by 2027. That's a CAGR of over 8%. And Fairfax India acquired its 65% stake in October 2024 for just short of $83 million. And that valued the business at just 9.9 times earnings, or 12 times free cash flow. Very, very conservative. Having seen the structural tailwinds in aluminium through Maxop and Janix, Fairfax India expects continued upside, powered by demand from construction, auto and renewable energy, and the China Plus One shift. If you're not familiar with the China Plus One shift, this is a business strategy where companies diversify their supply chains and manufacturing operations by establishing a presence in at least one country in addition to China, rather than relying solely on China. Needless to say, India is the primary beneficiary. So now you should have a really good idea of the Fairfax India portfolio of companies. Now we come to valuation. Across its portfolio, Fairfax India's investments appear meaningfully undervalued, especially when judged against peers in their respective sectors. What's striking is that this isn't due to underperformance or structural weakness, but rather the result of conservative valuation methods and prudent accounting policies employed at the parent level. The result is a portfolio of assets that's compounding in value while being capitalised at earnings and cash flow multiples well below those of comparable businesses, and this all suggests substantial latent upside waiting to be unlocked. Take Seven Islands Shipping, a profitable and cash-generative company, capitalised at just 4.6 times earnings and 3.8 times free cash flow. Remarkably low for a business that has steadily grown its fleet, maintains the industry best idle times, and generates substantial cash, including nearly $30 million in special dividends returned to shareholders. Similarly, Saurashtra Freight, which plays a critical role in India's port logistics chain, trades at roughly 11 times both earnings and free cash flow, despite a steady dividend stream and infrastructure-like characteristics that have already repaid almost half of Fairfax India's original investment. In financial services, the discount is even more pronounced. IIFL Capital, one of India's leading full-service financial firms, grew its earnings by 83% in 2024 and is benefiting from booming capital markets and record-high new account openings. Yet despite this, it trades at only 13 times forward earnings, far below global peers with similar growth trajectories. CSB Bank, meanwhile, boasts an industry-leading 4.7% net interest margin, loan growth of 26% and deposit growth of 22%, all while maintaining a capital adequacy ratio north of 21%. Still, its valuation remains modest in comparison to other high-performing private sector banks in India. Even 5paisa Capital, a rapidly growing digital brokerage platform with near 10% market share in a rapidly expanding retail investor market, and with 21 million app downloads and a strong foothold in high-frequency trading segments, its valuation lags well behind global fintech peers. Regulatory tightening may temper short-term momentum, but the long-term opportunity in digital financial services in India remains vast. Then there's National Commodities Management, which also reflects a similar theme. Though the business faced operational challenges in the past, it's now well into a turnaround under new leadership. With one of the largest warehousing footprints in Indian agriculture, plus a weather station network and financing platform. This business is uniquely positioned to benefit from structural growth in agri-logistics, yet its fair value on Fairfax India's books has not yet caught up with its improving fundamentals and long-term potential. There's no need for me to mention all of its investments, but you should be getting the general idea. However, let's not forget the jewel in the crown, BL, the airport. As stated earlier, its carrying value is at least 4 years out of date. The asset is undervalued for sure, and the anticipated IPO of Anchorage Infrastructure will unlock this hidden value. It's clear that Fairfax India's approach has been to account conservatively, often not reflecting full market value until it's undeniably justified. This is consistent with the transparent accounting practices of its parent, Fairfax Financial. This cautious posture conceals what is in reality a portfolio rich in optionality. As these companies continue to grow, professionalise, and in some cases reach the scale or market maturity that commands investor attention, there is substantial hidden value to be unlocked. With strategic exits, re-ratings, or simply continued compounding, the true worth of this portfolio could become increasingly visible over time, potentially delivering significant upside for long-term shareholders. This is all acknowledged by the management of the company. In the CEO's shareholder letter of March 2025, he commented, "While the book value per share of Fairfax India is $20.96, we believe that the long-term underlying intrinsic value is much higher." But the share price is currently trading under $18. In fact, it's closer to $17.5, representing a discount on an already discounted book value per share. After fair value adjustments, Fairfax India's true book value per share is probably closer to $27, meaning that the shares are currently trading at around 66 cents on the dollar. Here's some quick maths that might catch your imagination. If you were to invest at book value and compound at 12% each year, you would double your money in 6 years. But what if you invested at 66% of book value, which also compounded at 12% each year? In that case, you'd triple your money in the same 6 years. And this is what makes the current Fairfax India valuation so appealing. For foreign investors, currency risk needs to be considered, and here the Indian rupee has performed relatively better than most currencies against a very strong dollar, at least until the end of 2024. The Indian rupee has depreciated 26% against the dollar over the decade since Fairfax India went public in 2015. But 2025 has seen the dollar shift gears. It's now in reverse and falling against most other currencies, principally due to the ongoing debt crisis in the US. This may result in the Indian rupee strengthening, at least in the short term. And this may juice the returns of foreign investors in India over the next year or two. Another boost for shareholder returns is buybacks. As Fairfax India shares continue to trade at these depressed levels, the management have astutely been buying back shares. To date, the company have repurchased over 14% of their equity outstanding. While this is generally very accretive to shareholder returns, some of these repurchases were to offset dilution to settle performance fees paid to the parent company. So let me explain a little bit about that. Although Fairfax India is a corporate holding company, it has a fee structure similar to that applied by many funds. So first, there's an investment and advisory fee, an annual fee paid to Fairfax Financial for investment advisory services. This stands at 1.5% on deployed capital and 0.5% on cash. Second, there's a performance fee. So Fairfax India pays to Fairfax Financial a 20% performance fee on the increase in its book value per share, including distributions, that exceed a non-compounded 5% per annum hurdle rate. And this fee is calculated and paid over 3-year measurement periods. The current period runs from 2024 to 2026 inclusive, and it can be settled either in cash or in Fairfax India's subordinate voting shares. Since inception in 2015, the combined management and performance fees have averaged a little over 2%. But bear in mind, many of Fairfax India's assets are carried well under their true intrinsic value, and there haven't been that many realisations in the 10-year period. This could mean that the fees falling due in future will be substantially higher than those that fell due in the past. This fee structure is the subject of much debate over whether it's a fair incentive for value creation or an excessive charge that siphons value from public shareholders to the parent company Fairfax Financial. On one side of the debate, it's argued that the fee structure is an economic leak. The performance fee can be very large, particularly when a long-held, highly successful private investment is monetised, having been held on the balance sheet at a significant discount to intrinsic value. Said differently, a performance fee is intended to reward the creation of new value. However, the structure allows Fairfax Financial to be paid handsomely for the realisation of value that was already created but not yet reflected on the balance sheet. The relatively low, non-compounded 5% hurdle makes it even easier for this fee to be triggered by these monetisation events, creating a clear mathematical advantage for the parent company. Additionally, it's been argued that Fairfax Financial, as the controlling shareholder, gets a significant share of the upside without bearing the same level of risk as public shareholders. Some investors argue that this fee structure explains why the stock consistently trades at a discount to book value. On the opposite side of the debate, supporters of the fee structure argue that it aligns interests. They say that the hurdle rate, which focuses on compounding book value per share over a multi-year period, incentivizes management to focus on long-term capital appreciation rather than short-term trading gains. There's also the cornered resource arguments. Having access to the investment genius of Prem Watsa and his team at the parent company aids in identifying and nurturing high-quality Indian businesses. If the performance fee didn't exist, Fairfax Financial would have no incentive to allocate its best investment ideas and management talent to Fairfax India. So the fee ensures that the parent company remains focused on optimizing the performance of Fairfax India. This is largely supported on the facts, as the growth rate of the book value per share, even after accounting for the fees, has been substantial since inception. Having provided you with a balanced narrative, you're free to formulate your own opinion on the issue. It's also worth considering whether your interests are better served by investing directly in Fairfax Financial rather than in Fairfax India. It is, after all, the recipient of the management and performance fees rather than having to pay them. So, while Fairfax India's investments are long-term and illiquid, the fees paid to the parent on AUM provide a reliable periodic cash flow. So let's look at these two options, investing in the parent or investing in Fairfax India directly. Investing in the parent does not provide pure play exposure to the Indian market, yet Fairfax Financial owns 43% of Fairfax India, so there is direct exposure to India, with an added benefit of the diversification offered by its vast array of insurance and reinsurance businesses like Odyssey Re and Crum & Forster, as well as other public and private investments around the world. On the flip side, if you have a very strong conviction that the Indian economy and its specific holdings will outperform all other markets, then the best way to play the beta is by investing in Fairfax India, which will be much more sensitive to the outcomes of its Indian investments, for better or worse. The other factor to consider is that Fairfax India's stock has traded at a significant discount to its true book value, while Fairfax Financial typically trades at a premium. So if you believe that this discount is temporary, and that it will be unlocked by a major monetization event, then the potential for a one-time re-rating of the stock could lead to a higher return than investing in the parent over a short to medium-term horizon. So there's only one question left to answer. Is Fairfax India a good investment? If you believe in the potential of India as a market, you want exposure, but navigating the complexity of the Indian market is far from easy. Many non-Indian investors are unaware of their legal rights and tax obligations and struggle to keep up with frequent regulatory changes. This not only irks foreign investors seeking exposure to India, but it also frustrates local investors who would welcome the increased liquidity that more foreign investors would introduce into public markets if the rules were changed. However, investing in Fairfax India not only enables foreign investors to gain exposure to the exciting Indian market, but it avoids all of these problems, as Fairfax India is listed in Canada. So, while it has the in-house expertise to navigate the Indian market, you have exposure via an investment in Canada, thereby avoiding these problems. In short, the combination of India's growth prospects, the company's unique structure, conservative asset valuations, particularly the airport, active share repurchases at discounted prices, and a very experienced management with aligned interests looks very attractive. All of this suggests that this is a great business with strong, unique assets and a clear path to long-term increasing revenues and profits, run by great people and available at a great price. What's not to like?
We really hope that you enjoyed today's podcast, but we really only scratched the surface. If you want to explore any of the themes discussed in more detail, see the show notes or visit us at rockandturner.substack.com. Oh, one more thing. Be sure to like the episode, share it with others, and save it to your favorites so that you don't miss future episodes. Until next time, we wish you every success with your investments.